Car Talk this morning. James O'Malley of KeenOnTheMarket.com joins us for a look at those high-flying stocks. Good morning, James.
Good morning.
So I'm talking about Priceline, which is trading above $1,000, and Chipotle, which is almost $700. Is it worth it to buy these stocks, James?
Right, so for a small retail investor, there's one major thing that you have to consider when looking at stocks like this. It's that, generally speaking, your risk isn't necessarily more inflated when looking at a high-priced stock. Remember, one share of Priceline at $1,300 really does have the same amount of risk as 10 shares of another stock trading at $130. Now, generally speaking, these high-priced stocks aren't quite as accessible to retail traders because they cannot buy as many shares or have the ability to piece in and out of the trades as effectively. As an active trader, that is something that I always look to do, piece into positions and piece out of them. So if I were a trader that could not do that or did not have the capital to do that with such high-flying names, I would have to reconsider whether or not I wanted them to be part of my portfolio.
James, how do these stocks get so high?
Right, so these are both stocks that are just massive momentum names. Chipotle especially, we saw a huge gap higher in both CMG and Priceline on earnings, trading to these really lofty levels here. Now, there's a lot of different reasons why companies may not want to split their stock. There's debates over what that does for shareholder value. But generally speaking, I think that these are names that are going to have to split eventually if they want to draw attention from retail investors looking to diversify into these names, because they really cannot get into them or trade them quite as effectively at such high dollar amount for share prices here.
Thank you, James, for explaining that to us. Thanks for coming on the show.
Thank you.